Hi, hello everyone. So let's start discussion today on very important topic, which is the liquidity coverage ratio and the net stable funding ratio for in perspective of development financial institutions like NaFed, NaBFID. So I'll more or less specific in this video is a NaFed perspective in the risk management domain. So in this video, we are going to detail discussion or the key terms that will use in the net stable funding ratio and the liquidity coverage ratio. But before that, moving to the next slide, I would like to request you guys, if you are new to my channel and if you are interested in the field of quantitative finance or the risk management, where different roles like operation risk management, liquidity risk management, or the credit risk management or the market risk management, so please do like and subscribe my channel. So I'll create a video on this video and the IT domain like business analyst, qualitative analyst. So that video is also I'm going to post my channel. So please do like and subscribe my channel. So that will motivate me to create, help you to get a better job and also to prepare more and more such videos for you guys. So let's start discussion on what are the LCR and NSFR and the Basel III liquidity pillars that cover. These are the Basel III liquidity pillars, liquidity coverage ratio and the net stable funding ratio. So guys, you have to think if like the commercial bank like ICICI Bank, SBI, Kotak Mahindra, HDFC Bank, or you can consider Union Bank. So suppose if go to the bank and you have the 1 lakhs deposit in your account and you say bank, my 1 lakh deposit or your saving account will be, you want to withdraw, and at that time bank say we don't have fund and we are not able to give you at that right time the funds, so you can come maybe a day after tomorrow or 3 to 4 days, and at that time we will give you your funds. So how your reaction at that time, you just get angry and why I am not able to get my funds. So it is the liquidity. So bank always provide the money to the customer who owns it and who deposits in their bank account. So that's why to calculate that thing, how much the probability will withdraw within the 30 days or the 1 year of the, the deposit amount or the CASA balance account from that account. So on the different time horizon, so they need to maintain their liquidity coverage ratio. They need to check their, has they satisfy the liquidity coverage ratio as per the regulator will define, like the RBI is one of the regulator in India, and then the net stable funding ratio for time horizon is a 1 year. So the core idea is to hold enough high quality liquidity asset to serve the stress outflows. So if there is any stress outflow, suppose the customer need funds on immediate basis, interest rate increasing, so any trade situation they can consider, and they have in that situation the enough cash in their hands, so they can easily give your money. So the RBI mandate or the formula for this, the liquidity coverage ratio, is the high quality liquid asset, HQLA we also call, and the net cash outflow is that should be greater than or equal to 100%. So net cash outflow, so they have the high quality liquidity assets more than the net cash outflow. So they are the ratio between them, and it should be always positive, more than one. That ratio should be, and that indicating it is a good bank, or it is satisfy the liquidity coverage ratio. Then we will move on the liquidity net stable funding ratio. So it is also one of the key and the important ratio for the banks, and the time horizon for net stable funding ratio they calculate for the 1 year. So where they will core idea behind the net stable funding ratio. So they have the stable funding must cover the liquidity, illiquid asset and commitments. So they have the, if they have the some withdrawal of the bond or the commercial paper, or the FD, so they have at that time the sufficient amount, so they can immediately provide funds to their customers. So the formula or the RBI mandate or the Basel formula for this thing is the available stable funding divided by the required stable funding. So you should understand what is available stable funding and what are the required stable funding, it should be greater than 100%. So available stable funding, so how much the amount you have to stable funding and what are the required amount for the tables funding, that should be always more the available stable funding. So that's the net stable funding ratio and the liquidity coverage ratio. If interviewer asks you, can you please differentiate between the liquidity coverage ratio and net stable funding ratio, so you should convey them. So first and most basic difference between the time horizon. So liquidity coverage ratio is a 30-day ratio where we calculate for the 30-day, and the net stable funding ratio for the 1 year. That ratio we will calculate, or we will utilize, or we will use for the 1 year. And the core idea behind the net stable funding ratio is we do the stable funding must cover the illiquid asset and commitments that bank have. And the core idea behind the liquidity coverage ratio is hold enough high quality asset to survive the stress outflows. Where we do the stress testing, we consider the 100 basis point interest rate increasing, or the cost of offices or the cost of businesses increasing. So how, and the where the borrowing capacity of government is increasing. So that's why we calculate the high quality liquidity asset. On that will be use the RBI mandate. So that way you should answer, and the chances of you are to getting selected that role will increasing. So in the next slide, guys, we will discuss on the key definition you must know for that, the HQLA, available net funding ratio, required stable funding ratio, what is that thing, and I'll explain you in detail. So let's move to the next slide, guys. So first and the most important definition, guys, you should know, and you should hard to know that the high quality liquid asset. So what is the high quality liquid asset? So it is the sum of the cash that bank have, the government security, and eligible liquid asset. So it is a sum of these three things and the zero or low haircut. So it should be bank have the enough cash, enough government security, and eligible liquid asset that can liquidate within a 30 days. So that should be bank have enough, so that can the bank have sufficient liquidity coverage ratio. Then net cash outflow. So the bank need to be manage their cash inflow and the cash outflow. So where they don't face the asset liability management mismatch management. So it is and the worst and most important concept for asset liability management for the bank. And it is the bank will lend the loan in the infrastructure or the NaBFID finance for the 25 years, 30 years, 50, 20 years, but the borrow the money from the collect the money from the customers for the 10 years or 5 years or the 3 years or the 2 years. So there is a huge difference between the asset liability mismatch. So that's concept we will cover in the upcoming slides. But let's here stay on the liquidity coverage ratio and the net stable funding ratio. So the net cash outflow is a trace outflow minus the capped inflow over the 30 days. So what are the stress scenarios you consider while doing the liquidity coverage ratio, and simple and the base case of the inflows of that 30 days, and you need to calculate the net cash outflow for the organization or for the bank or the for the development financial institution. So let's move on the next and the most important topic, which is available stable funding, NASF. Available stable funding, you should keep in mind available stable funding, ASF. So it is the sum of the equity and the liability that bank hold with the more than 1 year maturity. So it should be less than 1 year maturity, and 100% factor for capital and long bonds. So it should be 100% factor for the bank which have and the long bonds. So that will consider in the available stable funding. And require the stable funding. So what are the required bank to do the stable funding based on the asset liquidity? 5% of G6, 65% of 1 year loans, and the debt NDB's National Development Bank. So that need to be maintained. And the run of the percentage of liability expected with withdrawal is a trace, and zero for the deposit in NaBFID, but 100% for the maturity of the commercial papers. So that the rate of should know, you should understand very well while answering the liquidity coverage ratio and the net stable funding ratio. So let's move on the very important topic where we are going to learn on the do the LCR and NSFR apply to NaBFID. Guys, before to giving the answer, is that apply for the NaBFID or the development organization, before that moving that thing, you should understand the nature of business or the business ecosystem of the NaBFID, how they work, what are their the motive, what are their goal, what is their objective, why these firms are introduced by the government of India. You should understand that thing, and after that you are eligible to think. Your mind should work. If you are understand the net stable funding ratio and the liquidity coverage ratio and the core functionality of the NaBFID, so you should able to give the answer, is that require or apply or not apply, if that applies, so why, and where that apply, if not apply, why, and where that can not apply in the NaBFID or the development financial institutions, guys. So let's start discussion on the NaBFID contest. So National Development Bank for Financing Infrastructure and Development. So no retail deposit is there. So they, you should keep in mind. So the sources of fund for the development financial institution like NaBFID, National Bank for Financing Infrastructure and Development, has no retail deposit. So there is no saving account or the current account concept or the fixed deposit or the RD concept. So you might think, where they collecting the fund? Funds are collecting from which sources? What are the sources for them to collect the funds to give the loan to the infrastructure projects like roads construction, highway construction, or the construction of the port, or the construction of the the resource energy resources like wind energy, solar energy infrastructure. So they will source their fund from the debenture market or the bond market, or the government is there one of the key source, or they can source from the pension fund, or they can source from the insurance mutual fund, or they source from the World Bank or the ASEAN Development Bank or the National Development Bank. These are the sources for them to collect funds and invest in the Indian infrastructure projects or the international of the infrastructure project. So you should understand that thing. So that's why the liquidity coverage ratio and the net step ratio for that thing is different. Also, they have the enough fund to pay the bond interest for the monthly bond interest or the yearly bond interest, or to pay the principal and return for the pension fund or the insurance fund or the World Bank or the the other institutions or the government, they collect the fund. So that's or the important for thing for the National Development Bank. So NSFR is the explicitly added for the National Development Bank, and benefit for to NaBFID is greater than 1 year with the 35% risk weight, and get the 65% for the rate. The required stable funding is a 65% and high 100%. So they should have the at least 65% for the required stable funding, and cheaper for the NaBFID banks. And then the liquidity coverage ratio. Let's discuss on the point which is important, guys. So it is on the 30-day time horizon, which we already discussed. So no deposits for that. Then no liquidity risks for the NaBFID. So there is a fixed kind of deposit. There is no. So you just you have the fixed liability. You just know at what time I need to pay how much the interest rate, or what time I need to pay the principal and the interest rate to the customers, because there is no CASA account. So no one the customer go to the NaBFID bank and request them to give my the saving account or current account bank. So there is no LCR or there is no liquidity risks like the 30 days time horizon. But bank need to manage or plan their the liquidity coverage ratio. So NaBFID has this commercial paper, bond maturity, undrawn infra commitment, and so LCR style is 30-day quality liquidity asset buffer. Still need to asset liability management, which is the most important, guys. I already told you. So we are going to create the upcoming videos for the asset liability management, where bank need to manage their the assets and liability and take their the profit. So there is a duration gap concept which comes. So we are going to discuss all these things in the upcoming videos. So liability duration gap, asset duration gaps, how to calculate, what are the formulas for that thing. So we will go into in detail that thing. So just you need to understand asset liability management is a management technique where the bank need to manage their the asset book of the asset portfolio and the book of the liability portfolio. So let's the bottom line for that, the NaBFID must manage run over the risks and structural maturity transformation to their the profits. So let's discuss on as we again discuss the one of the case study where we can understand and simplify the calculations of the liquidity coverage ratio and the net stable funding ratio. So let's suppose the asset size and the liability side for the NAFTAT bank, and then we will discuss how to calculate the liquidity coverage ratio and how to do the net stable funding ratio. Guys, the asset is a cash in the the NAFAD have is a 500 crore, and the GSEC is the 5,000 crore, and infra loans they will have to with the other bank is 8,000 80,000 crore. So they have the 80,000 crore which is mature in more than the 1 year infra loan, and the liability that have the equity for the 20,000 crore 5 years bond they issue in the market and collect the 50,000 crore, and the 6 month commercial paper of RS the 15,000 crore. So managing 30 days. So let's first discuss on the liquidity coverage ratio, and then we will move on the net stable funding ratio. So let's discuss on the high quality liquidity ratio. That's the NAFAD will have. So NAFAD will have the cash in hand, which is the 500 crore, and the GSEC bonds, which is the 5,000 crore. So the total high quality liquidity asset NAFAD have 5,500 crore. So let's discuss on the 30 days outflow for the NAFAD, and that will help you to calculate the net liquidity coverage ratio. So the commercial paper that NAFAD need to be pay in the 30 days with the 15,000 thousand, and the bond is 2,000 and the 10% of undrawn 1,000 RS, which is the total is 18,000 crore that the bank the NAFAD will have the outflow, and the trace outflow will be the 115%. So we need to do the trace on that thing, and that will be the value is at 20,700, and the total inflow is the 15 crore. So let's discuss on the liquidity coverage ratio, where we know the formula which we already discussed. So the high quality liquidity asset divided by the trace outflow or the total outflow that bank need to face, which is the 19,200. So it is a 28.6%, and that means which is a bridge need to more high quality liquidity assets that bank will have. So you need to do while you are really working with the NAFAD bank, you need to do that kind of scenario and suggest your the VP or the senior analyst or the ALCO committee or the risk management committee. You should have that calculation, and that calculation will tell this logic, and you should have more high quality liquidity asset. If you don't have, so you need to face some crunch of cashes, you don't have the cash in your hand, and you faced some the issue with the bank in within a 30 days. It is a one most important guys thing. So let's discuss on the next thing, which is important for the net stable funding ratio. Let's discuss on the available stable funding available stable funding and the required stable funding first, and then we will move to calculate the net stable funding ratio. So the available stable funding will be the factor like equity division 20,000, or the bond which will less than 1 year for the 48,000. So it's some of these is a 16,500. Okay, and then let's move on the required stable funding with the 5,000 plus 5% and loan of 80,000 plus 60%. So that is a 52,250. So that's the net stable funding ratio. It's comfortable and which we can satisfy. So the simple formula is available stable funding ratio and the required stable funding ratio for the net stable funding ratio. Available stable funding ratio and the required stable funding ratio is the simple formula for to calculate the net stable funding ratio. So these are the end of this slide, guys. If you are interested in the more in the financial risk management domain, or the credit risk, or the operation risk, or the liquidity risk management domain, or the market risk management domain, so please do like and subscribe my my channel. So I'll continuously creating videos on this topic and help you to get the better opportunity in the market, and definitely my videos will help you to get the higher salary in the market. And if you face any challenges in the market, or if you have any open points, or if you want to gain some knowledge how to do the interview, how to answer in the interview, so please do like and subscribe my channel and ping me or do message me. I'll definitely help you out on that find, and I will make sure you should be get selected for that role if you take more than 100% effort for this role. Once again, thank you so much, guys.